Welcome everybody to Money Mayhem. I am Travis Hoium from Asymmetric Investing, joined by Jose Najarro. Jose, how are you doing today? There's a lot going on in the world of AI and chips, so you got to be keeping yourself busy.
Yeah, pretty excited. I mean, it definitely seems like it's going to be at least a fun few weeks, maybe even months for the semiconductor market. Unfortunately, I mean, yesterday we had a great day in the semiconductor space. Today we're kind of following with a nice red day, though, Travis. So maybe I wish we were doing this live stream yesterday instead, so we could be cheering a little bit.
Yeah, it'll be really interesting to see as we get more information. We've already got a couple of questions. One that came in from Framework Investment that I want to touch down based on something that you wrote. But the first thing that we wanted to talk about today is the news out from DeepSeek, and this is a Chinese AI company, model company that is open source. Now,
Mhm.
I think the right way to say it is, at least from our perspective, from an investment perspective, we're still kind of like understanding what in the world is going on with DeepSeek, what the implications are for the industry long term. But they are building models that are far cheaper than the models that companies like OpenAI have built. Can you just give us an overview of kind of what they're doing and how they're doing it differently, how their costs are multiple orders of magnitude lower than OpenAI?
Yeah, so on the very top level overview, right, Travis? OpenAI to train kind of their O1 and their O3 models, they're using hundreds of thousands of GPUs, right? Of maybe for like O1 and O3, they might be still in the tens of thousands. I don't know if we've gotten to the 100,000 training clusters just yet, but it's still massive GPU clusters for training, right, Travis? For DeepSeek, the biggest thing is they were able to kind of compete with OpenAI's most updated model, their thinking model O1, with just using about 1,800 H800s, right? And that's like even a weaker down version of everything that OpenAI and all these other players have. And because of that, obviously, it's a lot cheaper to do the training. They're also able to kind of bring down the cost of offering those solutions to other players. But this is where I think we're going to get a lot of questions of what happens next. Right, Travis? One of the biggest questions for me is kind of like the AI diffusion rule, which is trying to create kind of a AI export that we got from the late administration, the Biden administration before they left. And one things that I'm thinking about is, sure, you can kind of come out with these models, but if we're treating Chinese models a little bit different from US models, just like we treat any other form of other product. Are rules like the AI diffusion going to prevent maybe big cloud players from allowing these models to go into the cloud? Which, if you're going to O1 and O3, you're going to need a lot of inference thinking, or like the DeepSeek version of it. You still need all that inference compute, and with 1,800 H800s, you can't really use that compute power for the inference to scale out dramatically. So I think that's the question of what's going to happen in the next, in I guess, in the next few months.
Yeah, and so my understanding about the way that this works is, and I'm going to pull up a few quotes here. Stratechery has done some, from Ben Thompson, has done some really good work on this. But what DeepSeek is doing is, instead of building this pre-trained model the way that OpenAI is, and the way that Alphabet has done, and kind of the traditional method over the past couple of years, is they have actually taken mostly synthetic data and then created an AI that then goes through this reasoning framework and says, okay, this synthetic data that you created, so not data from, pulled from websites or videos or anything like that, but just data that is made from artificial intelligence. And then it says, create an answer. We'll tell you which one's the right answer. And then the AI learns based on that. So it's reinforcement learning with an AI teaching an AI.
Mhm.
And so the costs, I'm going to just give some of the numbers here because they're a little bit crazy. Um, the at least estimates for right now is this model cost about $5.6 million to create. So you're talking about similar performance to an OpenAI model that costs at the very least hundreds of millions, if not multiple billions of dollars to create. And this is one of the things we talked last week on the show about artificial intelligence going from this world where we're spending a ton of money on pre-training to basically spending a whole bunch of money on thinking. So the AI goes through and it goes down a bunch of different paths, and then it determines which one is the right path, and then maybe there's multiple of those chains in any given prompt that you put in.
Mhm.
Now we're talking about the model being trained in a similar way, but you don't have to have the same cost going in on the front end. And so I'm going to actually put an article out about this later today. I didn't have time to finish it before our show, but my thesis is this is AI's Napster moment. And that sounds a little bit crazy on the surface, but I'm going to just read how I'm starting this. It created a world of abundance in the music industry, forever changing the cost and accessibility users expected from the industry. Simultaneously, it destroyed the economic value in creating music in the first place. And that seems kind of like where we are with AI, where you have these companies like OpenAI raising billions and billions of dollars, having hundreds of billions of dollars in value. And then this tiny little model creator basically takes their outputs, says, we're going to use this to create a model that's just as good as yours at a tiny, tiny fraction of the cost. And we're just going to give it away. So you create abundance from a user perspective and an expectation that this shouldn't cost me anything and it should be free and freely accessible. But from a creator perspective, from the people who are actually doing the work to create these models in the first place, the foundational models, where in the world is the value? And this is this weird conundrum that I feel like we're sitting at. I know it's kind of a lot, but where are your general thoughts there? Because it seems like these, we'll talk about Stargate in a little bit, but like, why in the world are we spending $500 billion on Stargate if we can build a model for $5 million?
Yeah, and I think that's where the biggest question lies, right, Travis? Because I would think it would be less questioning if it was only one big company spending this type of money, right, Travis? So we had kind of like OpenAI is spending these billions and millions of dollars on training model, but that's not the only player. You have XAI doing the same. You have Amazon, Anthropic. So why? I think it would have been so much different if it was just DeepSeek versus OpenAI, and then you would say, hey, like DeepSeek has super smart engineers. They're doing something right. Now my question is it possible that all these other great engineering companies, Google, Anthropic, and all these other players were just so wrong? And if they were so wrong, why are they not shifting so quickly if it's something that can help them move at quick levels? So I think there has to be something behind that maybe we, from this top level overview, don't really understand at the moment.
Yeah, this is going to be the economics behind this are going to be fascinating. I think that's really the question to me. And the reason that it layers into both a lot of what you cover and then a lot of what I cover is somebody's got to pay for the chips.
Mm-hmm.
I mean, at the end of the day, there's a ton of demand for these chips. But and I don't know if you've looked at this, but my understanding is that the depreciation value or the depreciation rate on even like the H100s is just crazy high. So even just like weird accounting things that companies have done, I believe Google went from a 4-year depreciation cycle to a 5-year depreciation cycle. That increases your net income. It doesn't change your cash flow, but it increases your net income. Is that going to be appropriate in a world where maybe these chips are worthless in 2 years? There's just so many strange outcomes that we're talking about hundreds of billions of dollars. We'll get into Stargate in just a second. Anything you wanted to add there? And then we've got some questions that I want to get to, but anything you want to add there before we move on to our next topic?
I would say if DeepSeek's model, and I actually was just watching a podcast, Travis. Unfortunately, I didn't finish it before we started this episode. Is Dylan Patel, huge the lead semi-analysis at lead analyst at semi-analysis, actually just did a podcast yesterday, and some of the questions that were discussed were about DeepSeek. So I'm gonna check that out later. I'm pretty sure if others want to go, just go to YouTube and put Dylan Patel and see the most recent podcast. But one thing that you mentioned, Travis, is DeepSeek. What they're doing is they're using these thinking and inference models to create kind of synthetic data. So you're still gonna need a player who has, in theory, high computational power that has more and more chips can create the data a lot faster or create even more data at the same time, right? So the next question is, does more data or having the data faster really matter? So, like you mentioned, Travis, I think it's going to definitely be something that we're going to have to hear about in the upcoming earnings. I think investors that are in AI companies are definitely going to bring up DeepSeek as it is making a lot of noise. So, hopefully, this earnings season we kind of learn a little bit more about it. And as the technology continues to evolve, maybe we start to see more engineers and scientists discuss it a little bit better for us simpletons to really understand.
Yeah, probably good for the hyperscalers, probably not great for the model makers. So we'll see how that plays out. Alan Fournier, if I'm saying that correctly, if I'm not, I apologize. Says playing around with DeepSeek and the output is similar to ChatGPT and Perplexity. So that is, I mean, this is my understanding, again, a true open source model. So
Mhm.
even the meta models, the llama models are not fully open source. There are rules behind them on what you can actually do with them. So this is actually open source and it's coming from China. So
Yeah. And
very interesting dynamics.
one thing there, Travis, I think this DeepSeek is going to be great for your do-it-yourselfers that want to add kind of like a AI model to their own local
Yep.
program. But I think if you're going to create an application out of it, you have to kind of think of the solutions that maybe DeepSeek as a whole doesn't get accepted into other forms of like you, for example, you might not be able to use it in certain cloud server providers because of certain regulations and certain things like that. So the scaling out of something like that is what's I think going to be the biggest question as well. It's going to be great for if you want to add it to your local PC, but can someone create an app from this? And what does that create? At the end of the day, like you mentioned, though, Travis, if they can, it's still going to be great for the computational power needed for the hyperscalers as they're going to be selling that inference one way or another.
Yeah. A lot to cover. So we'll I'm sure keep on top of this. The next thing I wanted to talk about is Netflix. And I'll take the chance here to talk about one of the concepts that I talk about a ton on asymmetric investing. And if you want more from both of us, our newsletters are on the screen there. Mine's asymmetric-investing.com. Jose's under What the Chip Happened. So I love that name. I love seeing that come across my inbox. But since the start, I have talked a lot about the smiling curve. And this is where you can find advantages in the market by finding companies that are living on one end of the smiling curve or the other. So let me just walk through this and I'll give you how Netflix plays into this. So the scale curve is something that we have lived with in the world for a really long time, right? Like if you had the biggest printing press, you were the dominant newspaper company in your local area, or you had the biggest TV audience, you could build scale. But if you were just like one crazy person analyzing stocks like we do, and you were just trying to like present that to random people on the street corner, and you didn't have a printing press, you didn't have a business. So scale completely changes in the world of the internet because now the scale is the world. So now you have billions of users. So this side of the business becomes much, much bigger. So now instead of the size of a big newspaper, at the best, you get something like the New York Times or Washington Post. I'm in the Twin Cities area. We had Pioneer Press and the Star Tribune, successful newspapers, but not Meta sized companies or Google sized companies. Now you're getting to a massive, massive amount of scale. What also develops is on the other side, you can have Jose and I creating content, doing something that's very niche and develop an audience because there's these distribution mediums like YouTube, like the World Wide Web, like Twitter, all of the social networks. So it creates if you look at industry after industry, you create this smiling curve. So what you want to do is you want to invest on one end of that smiling curve or the other. So you want to be either with the company that has a ton of demand and can therefore raise their prices and extract more value. And I'll get to some examples of this. Or be in a super, super niche business that's very, very high margin and generally very, very low cost. So you want to be here or you want to be here. Where you don't want to be is you don't want to be in the middle. You don't want to be, this is why Twitter's economics are not very good. This is why Snap's economics are not very good. I mean, you could talk about the details of all these companies, but at the end of the day, if Meta has 5 times more users and advertisers want to go there first, and they have a better advertising platform, and they're making 4 times more revenue. Now suddenly they're making 20 times more revenue overall because they're making more revenue per user and they have way more users. So you get curves like this. And this is the one that I used. Spotify is the first stock that I ever covered on asymmetric investing. By the way, this is up now something, as I try to find this again. This is up something like 200% since I covered it. But
nice.
But the reason that this works and becomes logical is because Spotify now has more users than any of these other networks. And guess what? Since I covered it, and this was just kind of coincidental, they've actually raised their prices. They're actually more expensive to get a Spotify subscription today than it is to get an Apple Music subscription. Why can they do that? Because they can now start bundling in things like audiobooks, and they can add value in other little ways. They have a little bit better user experience. So there's ways that you can push on that. Now, Spotify is a little bit unique because they are licensing music, but then they can move into things like video and podcasts and things like that. What's the other end of the curve? Taylor Swift, right? One person dominating a massive amount of presence in all forms that are, mass distribution. So that's kind of an outlier example, but that's sort of the two ends of the curve. When we go to Netflix, the curve is pretty simple. You have Netflix being by far the biggest, 200 and I'm going to forget the number, 270 million subscribers. The only company that's actually bigger is YouTube. YouTube generated over $50 billion in revenue on a run rate basis as of the third quarter of 2024. So we'll see what those numbers are when they report earnings. But those are the two ends of the curve. Now, I have invested in Disney in part because I think when ESPN goes over the top, that's going to be a huge driver for them from both a margin standpoint, like a revenue per user standpoint and an attraction of users. But again, you don't want to be these companies. But this is quarter after quarter and year after year, Netflix can do two things. They can increase their number of subscribers and they can raise their prices. And what this does is it creates this flywheel, because then if you think about, if you're buying content and a great piece of content comes out, who's going to be able to pay the most for it? Netflix. And then the next piece of, and that's going to attract more subscribers. And then the next piece of great content comes out, and who's going to be able to pay the most for it? Netflix. And eventually they're going to be at such a scale, and this is where we're at now, that they're going to be able to pay more than anybody else, and they're going to be able to have higher margins than anybody else. So this is, I think the dynamic that we're hitting with Netflix right now, where they're really pushing their pricing power and they're showing that this smiling curve kind of a concept just works so well in these internet businesses. And we see this over and over and over again. You can see it in social media. You can see it in search. I mean, is an extreme example, because, Google owns 90% of 97% of that market or whatever it is. But you see it in shopping. You see it over and over again. And so this is one of the, kind of concepts that I keep coming back to on asymmetric investing, because typically if you can find a company that lives on one of those ends of the smiling curve or is moving up the curve, then you're usually in a pretty good position from an investment perspective. So that's my lecture on the smiling curve, but one of my favorite topics because it plays out over and over again, and it's relatively predictable.
Yeah, definitely, Travis. I mean, you gave us some great examples there when you can think about it in the music aspect, you can think about it in the streaming aspect, you can even think about it in the semiconductor aspect, right? You can be a player that just focuses on highly niche data center chips and be really profitable. You can focus on someone who provides maybe just for certain markets high volumes, or you can be like the analog players, which has just tons and tons of chips at very low margins, and maybe that's where you don't want to be, or the memory space in general, right? So you might not want to be there in that smiling curve. So I think you can put it into any type of market opportunity and see where in the smiling curve your company is.
Yeah, and the big change is the internet changed this from being a very local dynamic where kind of the left side of that curve didn't often exist to now we're in a very, very global world. So that's just what kind of if you can look at almost every industry and over the last 20 years, that's a huge dynamic that's changed. Let's get to a couple of questions. I want to take one for you that came from investment framework investment on Twitter. Asked about the points you raised in your newsletter. Must have been this week. AMD is losing out to Broadcom and tech companies as a number two. And what you said is so far AMD has bet on AI Copilot PCs, but that may fail given that they're losing ground to NVIDIA. Do you just kind of want to give an overview of what you were talking about there? And I can pull this up on the screen as you.
Yeah. So Travis, I saw that tweet. I don't think that's my newsletter. I don't know where that's coming from, but I
Okay.
definitely share certain points to it. So I don't know if he maybe might have or not sure who he or they she if it was more of an overview of my video topic. But maybe
Gotcha.
if you could pull it up, Travis, just so I can kind of get my thought process.
Yeah.
But I
Let's see.
think the overall gist was AMD is normally seen as number two, but here AMD is actually not your number two, right? Your number two is Broadcom. And the reason being is because tech companies are moving into designing their own AI chips. Now, I believe there's some truth to this. So, on the top level overview, Travis, there's two main types of chips. There's your GPUs, which are great for a huge, huge amount of workloads. Variety, kind of your Swiss knife that has every type of tool that you need, and they're really good at doing everything. Then you have your ASIC solution, which is pretty much something that's only good for one specific workload. In the GPU market, you have two players. You have NVIDIA and you have AMD. NVIDIA is the one that's dominating because they're good at building systems, infrastructures. They're good at all types of workloads. Now, this is the overall AI chip market is really being driven right now, Travis, right, by AI. Either two main solutions, either training of chip or the inference of chip. Now, like I mentioned, the great thing for NVIDIA is NVIDIA's chips are really good for training. They're also really good for inference, and you can use them for a whole lot of other things. So if you buy an NVIDIA chip, while you might pay a lot more money up front, I guess the value of them, while it still depreciates, still holds some value because you can use it for other workloads. Right now, AMD's chip, they're not that great for training, but they're
Mhm.
kind of good for inference solutions. They're actually really good because they tend to have a lot of HBM per package or per chip. But if that's the only reason that you're going to buy an AMD chip, big tech players can actually even save more money by designing their own AI chips for inference workloads. So if your only reason to be bullish on AMD is because you believe they're going to gain in inference, then I think that's the wrong reason to be bullish on AMD. They can definitely benefit from the AI space because in a growing AI market, even if you're losing market share, you can theoretically still grow in revenue as low as all wallet spending is going. But their inference is not as strong. It's not a strong moat to really have there. I mean, a perfect example is I think we've talked about it in the past, Travis. Google has their TPUs. Google does not have any MI300X. Why? Because if you only care about inference solutions, you might as well just use the TPUs. Amazon doesn't have an AI, doesn't have MI300s. Why? Because if you only care about the inference side, they have their Trainium and their inferential chips where they can kind of pass off that offload. The only two players right now in the big hyperscaler space that have MI300s are Microsoft, because Microsoft doesn't really have an AI chip for inferencing. They have one on paper, but not one that they really have to really distribute this. And Meta Platforms, very similar reason. They don't have an inference chip, that they have one on paper, but not one they have mass produced. So I believe those statements are true. If you're looking at the AI chip space, Broadcom is the number two in the AI chip space. And I am bullish on AMD, but my main bullish case wouldn't be the AI accelerator. It definitely can grow from that because even growing a few $1 billion in revenue there can be drastic for AMD. I believe AMD has other growth opportunities as well.
And also we have Alphabet in there too,
Yeah.
who is just kind of a hidden player. I had a question that came in on my channel that I'll just show here. Asymmetric equity value makes a lot of sense to me, but what do you think about leverage and asymmetric tools of options? So this is a little bit more of a investing side, and asymmetric investing. What I'm looking for is 10x return over the next 10 years. So I'm using all these frameworks and kind of concepts to build a foundation that you can find stocks that have that 10x potential. What this question is about is using tools that have the option for 10x returns, like options. And this is something I've played around with in the past. But the problem with using financial tools to generate higher returns is they're very, very high risk. And one of the things that I keep coming away with is if you're not doing this professional, like trading options professionally, then options as a general strategy are probably a tool of financial destruction. Um, and I say this because I worked at a hedge fund as an intern in grad school, and the things that they're doing with options and the way that they understand the options market is just completely different than what you and I are looking at when we're saying, hey, what about going long, I don't know, Nvidia with options or whatever. And you can absolutely make good returns and get luck. I have gotten lucky with those before. I actually just put an options trade on, so I'm not saying that this isn't something that I would ever do. I'm just saying that if you're looking for asymmetric opportunities, this shouldn't be the main tool that you go to. The main tool that I go to is finding stocks that have 10x potential and where your risk down on the downside, not trying to have this ticking time bomb. Because I think one of the things that I've learned over time is I may be right on the direction, but I may be wrong on the time scale. And if you're wrong on the time scale and you're invested in options, your position goes to zero. So that's sort of the risk there.
Yeah, and
Um,
I actually enjoy that, Travis. I think that's probably, I feel like for every investor, once you have some form of niche, one of your edges, you could be right on a trend. It's
yep.
just you're just not right on the timing. And it's something that, for example, for me, I'm very bullish right now in the automotive market, mainly in the chip space, right? Obviously, right now we're kind of seeing that weakness in automotive space, but in the long term, I continue to see cars getting smarter, the future of autonomous driving, no matter who wins. So you're going to see more and more demand for chips in cars. So I'm investing in companies, but I just don't know when the turnaround story is going to happen. So I really wouldn't play options with those players because it can either be a few quarters, it could be even a year, maybe even longer than that.
Yeah, good point. Any of the other questions? There's one from Jax here for you.
I actually like that one. Yep. I
Yeah,
was going to ask
why
if
don't
you
you go
pull
for
it
that?
up. If you could just pull it up, so maybe the viewers, I don't have the opportunity. Yep. So Jax, great chat. Curious why Hynix rarely comes up versus Micron when you discussed investable options downstream of all committed capex. Is it because it's an international equity? For those that are not familiar, SK Hynix is the leader right now in HBM memory. They are the ones that are really providing memory for NVIDIA in all their AI chips. And the reason, I don't know if this question was for you or for me, Travis, but the reason I don't talk about SK Hynix is pretty much because it's very hard for my viewers and even myself to invest in it. It is kind of an international company, like mentioned, and the broker I use doesn't really trade it, or it doesn't make it as easy to trade it. Um, the Though they did just report earnings, Travis, last night, and they were really good. Unfortunately, the market, it did not meet expectations, but in forms of HBM, Travis, they saw huge growth this year. They just finished their fiscal year of 2024. They expect HBM revenue to grow over 100% in 2025. So obviously that kind of gives you some strong demand from their AI chip customers. It can either mean two things, right, Travis? It can mean one, more AI chips are going to be sold, but also you have that more memory per chip is also included. So they're growing. You can't really just say it's one or the other. It could be a mixture of both, of increase of chip revenue, AI chip volumes, but also the amount of memory per chip is increasing. The other thing they mentioned, Travis, is they're pretty much like Micron Technology sold out on HBM for 2025. And
Mhm.
by the first half of this year, within the next 2 quarters, they expect to have full visibility, nearly full visibility for 2026 already. And they're going to continue to increase capex on building capacity for HBM for the upcoming years. So, very similar to Micron, though, Travis. Last Micron reported earnings last month. They mentioned that HBM is strong, but the consumer market is still weak.
Mhm.
And that's very similar what's happening with SK Hynix. They just mirror that. And that's very true, as the PC cycle, the AI phone cycle is taking a lot longer to materialize. But we do have kind of some tailwinds pushing that up for the second half of this year.
One more question from Feel Love, if I'm saying that correctly. What are your thoughts on how long it will take for RxRx to develop useful AI for drug discovery? Is it too early to invest in biotech AI technology?
Yeah. So Theo, I love, maybe I always said the I love. I don't know which one of us is right.
Yeah. Is that an I or an L? I don't know the way it comes up with this font. It's I'm not sure.
So I actually do have a small position, Travis, in RxRx. Very, very small position. I want to say it's probably less than 1% of my overall portfolio. This is one of those companies that I believe is extremely high risk and extremely high reward if they succeed. The two markets that I believe AI can potentially revolutionize in the next 5 years, I think it's robotics and the healthcare market. So RxRx has a huge supercomputer that they're using to create AI. They're going to do things. Their AI model is already in. You can use it in NVIDIA's software ecosystem, their enterprise software. So now they just need to keep innovating. I think it's a very early company to invest in, but one that has has potential. So this is one of those, what I consider the I love, a gamble, high risk, high reward. But Nvidia does invest in them, so maybe that could be seen as, hey, look, they have some backing by it, and they're already inside Nvidia's software platform as well.
But to be fair, NVIDIA has invested in everyone who will buy or use their chips.
Hey, that is true, Travis. That is true.
Um, all right. There's a couple of questions about ASML. Do you want to do that now, or do you want to do that after Stargate?
Let's do it now, because I know some people were really. There was an earlier question about that.
Yeah.
Um,
Okay, go ahead.
so ASML. I mean, I'm not sure. Any comments on that? On the top level overview, Travis. Um, TSMC just reported earnings. They increased their capex dramatically. Since increasing uh, their capex dramatically, they went from 28 to 30 billion in 2024, and for 2025, they're expected to do somewhere between 38 to 42 billion. So over a 50% growth, I believe, if I'm using my numbers correctly. There in capex for 2025, 70% of that, Travis, they mentioned, is going to be on advanced manufacturing nodes. And the big ticker item in the build of materials for that is ASML's machine. So I think we have a nice tailwind from ASML, but very similar to what we talked about earlier, Travis, is I wouldn't play options with this because I wouldn't know when that curve is going to happen, of when the return picks back up, when they kind of make all those purchasing. But in the long term, you do have that tailwind. The other thing, Travis, is memory players now, as they are developing HBM, they're also focusing on EUV machines as well. Normally, most of memory chips weren't made on EUV product on EUV machines. Now, with the shift that they're doing, they're actually also becoming customers of these EUV players, aka ASML. So there's a nice amount of tailwinds, and then you have other things like the changes of how chips are being manufactured with gate all around. So long term, Travis, there's a nice tailwind for ASML. So while the stock might be getting beat up, I think the equipment space is going to be a real winner it's going to be a market beater for the next like within the next 5 years. If you look in the 5-year compounded annual growth rate, equipment players are going to be better than the overall market.
All right, let's get to Project Stargate. Um, I'll just give the high level overview here. Great photo op at the White House
Yeah.
and a big announcement by Sam Altman. But the two people that I don't necessarily trust going from announcement to something actually happen would be Donald Trump and Sam Altman. So so they announced this $500 billion investment in artificial intelligence stuff throughout the day yesterday. There was quote after quote after quote. Elon Musk was dumping on this, saying that funding was not secured. SoftBank, who's one of the investors, has less than $10 billion actually secured for the investment. He was subtweeting OpenAI. Microsoft CEO just dropped the bomb of the year, and he just said,
Mic drop.
"You know
Yeah.
what? We're Satya Nadella, we're going to invest $80 billion in CapEx. I'm good for my 80 billion." And he basically just said, we're not putting anything more into this. Like, this was already happening. So what in the world is going on here? Is there anything new here? Or is this just people repackaging the investments that they were already going to be making and that we sort of already knew about 3 or 4 months ago?
I think there's some new stuff to this. Microsoft is not included in this money
They were
coming
in the
in.
press release. They were not in the photo op.
Yeah,
It was
so
kind of bizarre.
they're gonna be technological players, but they're not gonna be. It seems from the thinking they're not gonna be financial players. The big financial players are gonna be um, MGX, which is kind of this group that came out, I believe, from the Middle East. Not exactly sure where they're coming from, but they're this huge. They have a lot of money. They definitely do have a lot of money, and they are playing in the AI space. I forget the super popular company that they invest in, but yeah, MGX. Then you have SoftBank, and to me, one thing I did not like, Travis, is I talked about this when they in the video on the channel is ARMS was mentioned as a technological player, and the
Mhm.
next day, ARMS stock price went up over 15-16%.
Yeah. Yeah.
There's no real way ARM is a technological player. The only way they're a technological player here, Travis, is by kind of a loophole that they're going to be buying a lot of NVIDIA's chips, and NVIDIA has the GPU and CPU combo, and that CPU combo is an ARM architecture. So it just didn't make sense for me for ARM to be there, except maybe pumping some of that ARM price up so
Yeah,
SoftBank can maybe
Masa-san.
Masasan maybe can sell some ARM stock so they can fund it, so they can have more funding. I'm gonna make a wild guess that we're gonna start to see maybe some selling pressure on ARM within the next few months as SoftBanks needs to build up some form of equity or actual cash to be able to fund this. Um, there are new plants being built in Texas, and I think Semi Analysis just dropped an article today, and they kind of showcased that, hey, look, this is true. They have like this satellite service that they purchased that actually showcasing the builds being built out right now. So we
Yeah, and they
can
do this
say
for
that,
every fab in the world, right?
yeah, they have some crazy. I mean, they have a lot of different models. I think to be able to see that, it's a few $1,000 subscription for that one. I personally don't have that one. If you're just using their newsletter, it's a little bit more price for investors. But they sometimes show you these things from their other models, and they showcase that, hey, look, they are building these data centers right now. So there is some truth to it. I think there's always some truth and some lies. So they're definitely building new stuff. Um, I think this is really great news for Oracle. I think it was smart for Microsoft to do this too, Travis, because OpenAI is that child that just wants a lot of money, right? And Microsoft, they
And they seem to be done with it. Like Satya just seems completely over the concept. He's just like, Altman, just lose my phone number, please.
yeah. So he wants all this money, um, And Microsoft, while they're spending $80 billion, $80 billion is not no laughing matter. At least they want to control themselves. I wonder how much it really would be if they would say yes and yes to Sam Altman all the time. Um, so OpenAI and Microsoft was like, hey, look, normally we have kind of this exclusivity that you can use our cloud. You're only able to use our clouding solutions. But instead, now that has shifted a little bit. Now Microsoft has the first right of refusal. So
Mhm.
Sam Altman can still come to Microsoft first. They have to come to Microsoft first and say, hey, look, I want to use your computational power, or I need more investments here. Microsoft can now say no, and Sam Altman can now go to another player and kind of build that computational somewhere else and use that other computational for training. That other player is Oracle, Travis. So it's definitely really good news for Oracle as they're going to get this new revenue in AI infrastructure. Supply as OpenAI is going to be using them. So I think it was kind of a smart move for Microsoft while they do kind of maybe limit their growth a little bit from Sam Altman's computational needs because Sam Altman pays Microsoft for that computational needs. Now Microsoft doesn't have to invest as much as they really want. But Sam Altman can still go to other players and build up infrastructure and still kind of continue to evolve. So I think it was a good player for, at the end of the day, the cloud server providers. Maybe Microsoft limited their growth a little bit, but they're also limiting their expenses, their capex by a lot.
Yeah, we'll see what the details are as this comes out. My understanding is that the way to think about this is more as what's called a prospectus, which is kind of like, hey, I'm going to be starting this joint venture. Who wants to join me from a financial perspective? So, I mean, I think that's from Masa-san's perspective, probably a
Mhm.
more accurate representation of what's exactly going on. But, you know, in my mind, that announcement comes on top of the first topic that we talked about, which is DeepSeek, which is making an AI model for pennies compared to what OpenAI is spending. There just seems to be some sort of collision coming in the future, and I don't know what that looks like, but that's something that I think we're gonna have to analyze over the next few months and years because we're talking about a lot of money even for sovereign companies and for the biggest most profitable companies in the world. Any final words here before we sign off for the day?
Um, mm, I mean, the Wink had a question, brother. Please, should we sell Nvidia? I mean, I don't normally say when to sell, so I don't know. I mean, the Wink. If I think just if you're an Nvidia shareholder, Travis, um, you need to have the full bullish thesis that AI is real, and that you're going to continue to see computational growth in training, but also in inference.
Yep.
If you don't believe that's the case, if you don't believe we're going to continue to see investments in AI, and if that's a worry about you, then I don't think Nvidia is the company to own. Because at the end of the day, if the AI market is not real, the spending in Nvidia is going to drop dramatically, and the stock price is going to follow that, maybe even at faster levels. So I think to be an investor of Nvidia, you really need to have the understanding and kind of the bullish thesis that you are set in stone that AI is the real thing.
Parzival Zero just came in with a question. The models that are made for pennies cannot be innovated above current levels. They just copy the good models, but it takes the billions to spend to actually make it better than it currently is. Yes, 100%. But that's the problem. I mean, this is the dilemma for these companies is who is going to, let's say the next great model is $20 billion. But you know that the second you release that model, someone is going to come in and use that model to train their own model that costs $20 million. Who's going to build that model? Like, who's going to burn $20 billion and know that there's no economic benefit from it? I think this is just sort of like the prisoner's dilemma that we're in right now. And I don't know the answer to what happens next, but I think this is one of the fascinating things with artificial intelligence right now is that's why I called it the Napster moment. And like I said, that will be coming out later today. So if you want to read that, sign up for Asymmetric Investing. But um, Napster made music more available, but it killed the economics of the industry that actually produced the music. And it took, I mean, I think it took almost 15 years for Spotify to really build a business model and build any sort of scale to kind of rectify what had been broken by Napster. So it's going to be really fascinating to see what happens there.
Mm, definitely. And I think at the end of the day, Travis, is gonna definitely be I think we're gonna start seeing a world where inference is gonna be a bigger topic to discuss.
Yeah.
Because and another question, Travis, in the AI space is like, at what point do us as humans stop caring about the next generation of model? Like,
Yeah.
I think already, like, O1, people say, hey, look, it's amazing, but it's only amazing, it's really really amazing and and it blows your mind if you're using it to the full extent. But out of all the human populations that are using AI, how many of that percentage is using it to the full extent? I want to say it's pretty low level. So
Well, and
um
we're at the point too where and you have to go back through history to sort of wrap your mind around this, but usually the technology and the innovation happens and then the products come years and years later. I mean, the iPhone didn't like they didn't invent a lot of new things with the iPhone, but they figured out how to make it into a product that people wanted to have in their hands. Most of the infrastructure for the internet, the way that I use the internet today is very similar to how I used it in college when I had a T1 line. Like it was magical going from a dial up to being able to download Napster and get songs in a few seconds. Um, it took another 20 years for that to go from being available at universities to being available at home. So you're totally right that the models that we have today are probably good enough to do a lot of the things that people will want to use AI for in the future, but we haven't figured out those products yet. And we're
yeah.
iterating. I think we're starting to move in that direction, but I don't think we've had a whole lot of, maybe people use ChatGPT, some people use Gemini. Those are kind of iterations on things that already existed, but what's the new thing? And I don't think we've fully answered that yet.
Yeah. So, and I think 2025 hopefully is a year where maybe we start to see what this real AI agents are. Maybe that could be one of the models that comes out from it.
Could be.
So like I said, Travis, it's definitely going to be an interesting year.
All right. Thanks everybody for watching. Don't forget to follow both of our channels on YouTube. We're also on Twitter as well. And then, of course, our newsletters. You can start with both those for free. And then I've got a premium site as well. I'll be coming out in about a week or so with my buys for February for my asymmetric portfolio. So check those out. Thanks for watching. And we will be back next week, either same time, same day, possibly Friday. We'll figure that out and let everybody know on Twitter and YouTube as well.
Thank you. Appreciate it, Travis, and appreciate all the viewers. Hopefully see you again next week.
All right. Have a good one.